So this formats as follow for the sole traders, partnership companies, the normal companies that exist in the world. Right now, let me give you a small introduction of consolidation, just a verbal explanation, just a short one. And after that, we'll take a short break. And after that, we'll study the detailed consolidation. We'll just do the one part today. And hopefully the questions will be done. I'll try to do them today, but if not possible, we'll do it in the next class. By the way, tomorrow is a holiday. Okay. We'll continue on Sunday with the next class. Just a second. Okay. So
I can ask you something.
Yeah, sure.
On Sunday, can we do like our lesson, like, I don't know, at 10 o'clock?
Yeah, sure. So you're 10 a.m., right?
Yes.
Yeah, sure. That's because on Sunday, all of the day, most of the day, I'm free. So any time will be suitable for me. Okay. Okay. So regarding the consolidation, let's discuss the basics first. Let's discuss a short 1 or 2 minute explanation. After that, we'll take a break. So what happens is that in consolidation, you just need to remember that two companies combine into one company. Okay, let's say that all of the people of the world know that Facebook acquired WhatsApp as well and Instagram as well, most of the social media companies. Now people are saying that it has become the social media giant, and yeah, it is a giant in the whole world, right? Because everyone uses Facebook, everyone uses WhatsApp, Instagram, all of these things, right?
Yeah.
So what happens is that Facebook, whenever any company acquires another company, it is called a consolidation process, and that process we are going to study. It involves different kind of things. Now there are two parts to consolidation, right? I'll show you in the study text as well. Just a second. Let me open a new one. So there are basically two parts to the consolidation. One is called the statement of, I'll show you in the index. 1 second. So these are the two chapters. Remaining one we'll do in the other classes. Just like 3 or 4 things are left in the chapter. Like this one, we have studied this chapter 17 just a while ago. These three I would say are left, right? But the major part will be covered in 2 or 3 days. So let's expect that by the end of next week, by next Sunday, we'll be done with the whole syllabus, hopefully. Okay, now what happens is that consolidation has two parts. We will be studying just at chapter 21 today. I'll try to do some questions as well, but if not possible, we'll do it in next class. Now first part is known as statement of financial position. Now these two, statement of financial position and profit or loss, it's not same as the normal one that we just studied, but it is very similar. It is very similar. I would say 60 to 70% it's similar, but the basic core concepts are different in this consolidation, because two companies are joining together, right? It's becoming one group. So that's why there is a separate topic for financial position. There are separate rules and separate rules for profit or loss as well in this case. Okay, right? So I gave you the introduction. Let's now take a short break, like let's say 5-6 minutes, right? And after that we'll
yeah, sorry. And the statement of changes in equity, is that, are we going to study that one?
Yeah, that we're going to study. But like I just told you, this chapter 17 is not done fully right now. I've just done 2 statements. Yes, you're right. Actually, there are a lot of statements in that, like changes in equity as well, some other ones as well, cash flows as well. So what I'll do is that we'll do the changes in equity once we start cash flows, because it's related to that. It's very closely linked to this. So I'm making the things easy by linking chapters here, so that time is saved as well. And why I did these two first, because these are directly linked with the consolidation process. Okay, right? So just let's take a 5 minutes break, and after that we'll start with the first topic of consolidation. Okay, thank you. Okay. So fortunately the notes I just found out, they're available over here with me. So let's discuss these from here. Okay, so for consolidation there are two words used over here. There are two main words in consolidation. Like I just told you that one company is acquiring the other company. So over here I've given the example as well. Like let's say Facebook acquired WhatsApp over here. Okay, so the first word you can see over here, it is called parent. Right now, parent is basically called any company acquiring the subsidiary. Okay, now let's take a small example, again that same example. So when Facebook purchased WhatsApp, now Facebook is called the parent company, right? And WhatsApp is being purchased, right? It's being purchased by someone, by Facebook. So that's why this will be called a subsidiary company. Okay, so the parent is the company which acquires the subsidiary. Parent is the company which takes over the subsidiary. Okay, now who is the subsidiary company? Any company purchased by the parent. So very simple definition, right? So subsidiary company is the one who is being purchased, and it is being purchased by which company? Parent company. And parent company is just like, parents in real life. So over here as well, the parent company is acquiring the other company. Now it is just not uh, for one company. You will study in the further exam as well, like in F7 and SBR, the next exams. This goes on to either more subsidiaries as well. Like in some cases you'll study not in F3 level, in the advanced level, the professional level exams, like you'll even get to see 3, 4, 5, 6, 7 subsidiaries, right? So an actual group of companies work like this in the whole world. Like they have purchased many kind of companies, many different kind of companies. Okay, so this was a relationship between parent and subsidiary company. Okay, now control of parent company over subsidiary company always comes on more than 50% ownership. So this is a very important statement, that this basically means that there is a word over here which is called control, right? And whenever we say that parent company is controlling the subsidiary company, is only when it purchases more than 50% ownership. Now just adding a small topic over here. If you remember from the capital structure topic, I told you there were two kind of shares, right? One was called the preference shares, right? And one was called the ordinary shares, right? If you remember. So from preference shares, you remember that I told you clearly that preference shares have no voting rights. Even if you purchase 100% of preference shares of one company, you cannot become its parent, right? You will have no control on that company because you don't have any voting right, right? Because these are preference shares. But this basically depends. The more than 50% ownership basically is considered with this part. More than 50% ownership should be of ordinary shares, not of preference shares. Because preference shares does not mean anything. People just purchase preference shares just for enjoying the money that they get, right? Enjoying their benefits that they get. They get the dividend.
So ordinary shares can vote.
I'm sorry.
The ordinary shares.
Can you please ask again?
Those that have got ordinary shares, they can vote.
Yeah, exactly. So they have the right to vote as well, and basically their decision is heard by everyone. Now, if you're, let's say you are 100% preference shareholder, if you speak anything, no one will hear you. It's a very simple concept, right? Because you have no voting rights, right? Everyone will basically they will turn you to mute. You can easily remember it as this, like in preference shares, right? So in ordinary shares, yes, everyone hears you as well, depending on your percentage of ownership. But in ordinary shares, I told you there is a one drawback in this, that you get dividend on the last priority. The preference shareholders get the dividend on first priority, but ordinary shareholders just get them on last priority. But the benefit over here is that you get the voting rights. Okay, so this was about control. Now let's see afterwards. This is also a very important graph over here. So I'll start from the bottom over here. You can see I've written two percentages. If the holding is between 0% and 20%, right? If let's say a company has purchased another company 17%, 15%, 10%, if it is within 20%, then it is called a simple investment, right? It's just a simple investment. Let's say I was just bored and I just went on to the stock market and I just purchased like 5% of the shares just for fun, let's say. So it will be called a simple investment because there is no seriousness in this. It's no control. It will be very small amount. Maybe it will be less than even $50, right? And who can even get a control for company in $50? No one can, right? So there is no control in this case. It will be called a simple investment. Okay, now the more serious option comes over here. If the holding is between 20% and 50%, it is called a associate. The company is called associate. Okay, so what we have to do in this case is we just have to add the profit share. There are three stages. Okay, in this case, the third one is the highest level. The third one is this control one, which we will just be discussing in just a minute. But associate is basically one company. It's written over here as well. Let's first discuss this. In associate, what happens is that you get no control, because you can see still it's not majority, it's still less than majority. So 20 to 50% is more serious than the simple investment, but it's still less than majority. So it's like a middle. We cannot go back, we cannot go forward, right? So the word used over here in financial accounting in formal terms, it is called significant influence. Okay, now I was giving you an example of simple investment, right? And in that, let's say I was just bored, I purchased $40 or 40 pounds worth of company shares. So obviously it will be, let's say, 10-15%, right? It will be called simple investment. No one will be ready to hear me in that company if I go, right, in the meetings, let's say. But in associate, what happens is it's a bit higher consequence. What happens is that you are heard in the decision making, your point of view is heard, but actually you are not the decision maker. Okay, so the ultimate responsibility for decision making lies with the parent company, the one who is purchasing the majority of the other company, which is this higher stage that I'll just come into the 1 minute. Okay,
sorry, I didn't understand why associate. I don't understand, the link with the parent.
look, basically we are not yet discussing the parent subsidiary. Parent subsidiary comes under this level and under this control. Okay, let me write over here just to make it clear. Consolidation comes at this level.
So why is associate significant influence and then parent is involved in decision making?
Because look, what happens is there are 3 stages of investing in companies, right? People choose to invest in companies in any of these 3 stages, right? So right now we're discussing the second stage. In second stage and the first stage, there is no parent subsidiary. Only in the third and the highest one, the consolidation happens, and over here in this control phase, there is a parent subsidiary relationship. Okay, right? And because you see, I explained just over here that control will come if the ownership is more than 50%, right? Below that, there is no control. And if there is no control, no parent subsidiary relationship, no consolidation. Okay, right? So in associate, what happens is, this is also very important. The reason I'm discussing is that this can also come in exam. Okay, we cannot ignore this as well. So significant influence basically means that you are influencing their decisions to just a small extent based on your holding of the ownership, right? You are just influencing them just a little bit, but it's more significant than the first step. It's much important and significant than this simple investment. Okay, the ultimate responsibility lies with the parent, right? But in associate, there is no parent subsidiary. It's also just treated as a normal, like a simple investment. But what features that we get over here is that we just add the profit share over here of the associate company. The only benefit we get is that we just get to add the profit share. Let's say that I have acquired a company called ABC company, just an example, and this I have acquired just 30% shares of ABC company. So according to this table, what will be the status? The status will be associate. I will say that I have associate which is called ABC company. I'm not the majority shareholder. So what benefit I'll get over here? That I will just get to add the profit share, and the profit share will be not full. Let's say this ABC company has $6 million of profit. Okay, so I'll just add 6 million into 30% based on my percentage. Right, in my financial statements, I'll just show other income, and that will be, let's say, I think 1.8 million, right? Yeah. So 1.8 million will be my earning that will be showed in my financial statements. But right now there is no control, no consolidation, no parent subsidiary. Okay, right? Now there is one more example. In associate, what happens is, like, let's say there is a significant influence, right? So let's say this BOD is basically board of directors. Okay, so if one company has 10 board of directors, if this company is my associate, right, I basically I have the voice to appoint 3 board of directors over here, at least 3, because that is approximately 30%, right? It can be more as well, but it cannot be more than majority. More than majority in this case is more than 5 directors, right? And that can only be done by the parent company. Okay, get it? Right. Now let's come to the last stage, and this is the most relevant over here. right? This is called the control stage. In this, what happens is that the parent company acquires the subsidiary company for more than 50% ownership. So it's basically between 51% and 100%. And this process is called consolidation. Consolidation literally means to join together all the financial statements items together. Okay, either it's non-current assets, either it's current assets, everything, each and everything we start to add together, because now we have got the control. We can just kick out the associates and the simple investors as well in this case, and we can also occupy their share as well, because we are the superior ones over here, right? So this is what happens in consolidation. And in formal terms, it is basically called line by line item adding of financial statements, because we don't leave anything, we add it line by line, each and every line. Okay, got it. So this was kind of an introduction, a much detailed introduction. Now let's start discussing some of the details, because we'll just be finishing this chapter, most of it, and remaining questions we do hopefully in the Sunday's class. Okay, now the second word over here, basically the third word over here, is non-controlling interest. This is also a very, very important one. Okay, now let me go back to this example, this Facebook and WhatsApp. Let's say Facebook acquired 80% of the shares of WhatsApp. 80% of the ownership, and that is ordinary shares. So that means Facebook is still the control over here. Facebook has control over WhatsApp, because it lies in this category. It is called control. We cannot say it is significant influence or associate, because it is more than 50%. Yes, it is majority, but you will be thinking, what will happen to the remaining 20%? Still, it's not 100%, right? It is 80%. So what will happen to the shareholders of WhatsApp who have purchased just 20% of the shares, the remaining 20%? And these will, in this case, be called non-controlling interest, of which the short form is NCI, non-controlling interest. Because why it is called non-controlling interest? Because these 20% will just be, time passers. They actually will not be involving in any kind of decision making, because obviously they're within this one, right? Simple investment. So all of these 20%, maybe 1%, one person may have 0.5% shares, one person may have 5% shares, one person, let's say, may have 7% share. So it is basically an accumulation of all them. Okay, so this means that they are still not responsible for any kind of decision making. Their voice will not even be heard. Maybe they're not even in the country of the company that's operating. Maybe they're abroad, right? They have just invested and just forgot about it. So these people, these investors, the remaining ones, are called the non-controlling interest. Now, reading the definition, these are other people who own remaining shareholding of subsidiary company, afterwards parent control, right? So after the parent control, anything remaining, any ownership remaining, is called the non-controlling interest. Okay.
Sorry, the rest, like so they are the associates and symbol investors, right?
Exactly. It depends on the percentage of shareholding, but in most cases we'll say this first one, the simple investors, which do not have any kind of basically relation in the company. They don't make any decision making. They're not even heard. They're just investing for fun, right? But let's say if this gap was more, let's say, let me change this percentage a bit more. Let's say if this was 55%, still Facebook is the majority. It is controlling WhatsApp because it's more than 50%, right? The other ones are 45% over here, right? So this makes a very tight match, because what happens is that these people, these 45% one, these can group up and they can just purchase the more 5% as well. So that makes it 50-50, right? So that is the most dangerous situation in the company, because in that case it's basically called joint venture, right? You might have heard of this, right? Like both companies are controlling evenly. So in that case, most of the conflicts has happen as well. Like, I am the shareholder. No one can say that I am the controller over here, because both companies are the controller, right? So these are some kind of complications that happen in the company. It all is shareholding, but we just need to know the name that is given to the remaining shareholding other than the parent. Okay. Similarly, if parent is owning 70% of subsidiary, then the remaining 30% in this case will be called non-controlling interest. Okay, right? Now we'll discuss shortly the 5 workings over here, right? And in detail we'll be doing the questions hopefully in the next class, but we have to discuss these working today. Okay. Now there are 5 kind of working right now. Again, remember, let me remind you, we are studying the financial position. We have not yet jumped onto the profit or loss. That is a separate chapter that has separate rules. Okay. Right now this is just the financial position, the consolidated statement of financial position. Okay. Now this is basically the method of consolidation, like how do we start doing consolidation, how do we join both accounts. Okay. So the first working, this first working is just merely, you can say, just a formality. It does not actually make sense, it's just like a formality. Let me explain you. So first working is called group structure, right? So what happens is that in many annual reports and many financial statements, this group structure is there just to explain the people who are not literate in accounting knowledge, right? Just to explain them that what percentage we have acquired of which company. So let's say group structure will be of like this: Facebook, and then there is a big line over here, then WhatsApp, right? So Facebook has acquired WhatsApp of which percentage? Let's say 90%, right? And remaining 10% will be clearly written as NCI over here. So this is just, we can say, a small diagram or a sketch which is just representing that which company has acquired which company, what is the shareholding over here, right? And how much percentage is the non-current, non-controlling interest over here. Okay, this was the first working. It's very simple. Now the more detailed things start from working 2 over here. I'll try my best to explain in much easier manner over here. Okay. Now working 2 is called net assets of subsidiary. Okay. This is again called net assets of subsidiary. So let me first give you a small short concept that will help you a lot in understanding this. This is very separate to all this. Okay. Let's disconnect from all this. Let's just focus on 2 minutes on this concept that I'm just going to explain you. Okay. Now what happens is, let's say if Facebook is acquiring WhatsApp, right? So any company, if any company purchases another company, if a parent company is purchasing a subsidiary company, so always parent company has to pay 2 costs. 2 costs it has to pay. The number 1 cost that Facebook will have to pay for acquiring WhatsApp is number 1, net assets. Okay, if you believe me, if you understand this topic, this small concept, you will say that consolidation is just a piece of cake. Okay. Now every kind of company which is purchasing the subsidiary company has to pay 2 types of cost. The first cost is called the net assets. In this case, net assets of WhatsApp. And net assets, if you remember, we studied this before as well. I told you net assets are exactly same as capital, right? And if we write the capital formula, it is basically asset minus liability. And net assets is also called capital, right? So if capital is also net assets, it will have the same formula over here, right? So net assets will also be equal to asset minus liability. So basically the net assets of WhatsApp, Facebook will have to pay basically all the assets excluding the liabilities, because liabilities it will not be liable for. It's WhatsApp responsibility to pay off all the liabilities, right? Now net assets will normally be of a very small amount, and it is actually of very small amount. Let's say it's just $15 million, which in business terms, looking at WhatsApp, looking at the size of WhatsApp, it is very small, right? $15 million is nothing. Now the second main kind of cost, is, the first cost was net assets of subsidiary. Second main cost is goodwill. Right? Now let me explain you what goodwill means. So goodwill is, in simpler terms, you can remember it as brand name encashed. Okay, so one is basically brand name in your mind, right? If, for example, if I'm going to buy an Apple product, there will be a brand name in every kind of every person's mind, that brand image of every brand. Like it may be a clothing brand, it may be a technology brand, right? Like they produce good products, they produce bad products, everyone will have a different kind of brand name. Now this brand name in financial terms, in financial world, it is encashed as well. Encashed basically means that it is told in monetary value. Okay, so if brand name is told in monetary value, in this case, It is called goodwill.
How do you value that?
I'm sorry?
How do you value that? How?
Basically, that is the task of valuers of the company. The company person, the company people, the company accountants know this well. You will be studying hopefully in the next part of the topics, right? Next part of the exam, sorry, right? It is a very complex thing. It's not a very simple thing, right? I would say I don't think this is anywhere included in ACCA because it's kind of a more professional thing. If you do a more professional qualification, you will easily get that. And in companies also this is done. It's a very, very tedious product, right? It's a very tedious, very careful process, right? And obviously it involves a lot of cost as well to calculate the goodwill of a company, right? Now goodwill is, I would say it is 100 times of net assets. So in this case, the goodwill alone of WhatsApp, obviously everyone knows about WhatsApp, right? Everyone knows about Facebook as well. But right now we're talking about subsidiary. Like what will parent pay to the subsidiary to acquire it, right? So let's say for WhatsApp, the goodwill estimated by the people is $6 billion, right? So you can see $15 million is nothing in front of $6 billion, right? Now what will Facebook do? It cannot pay $15 million to acquire WhatsApp. In that case, it will just get hold of the assets of WhatsApp, not actual control, right? So Facebook, for actual control, for having actual control, it will have to pay 6 billion plus $15 million. Okay. So again, I'm repeating, goodwill is the brand name which is basically told under monetary value. It is not like a mind game, it is an actual monetary value, right? And this is, if we have studied revaluation, right? It is just like revaluation. It is measured under active market, like what is going on right now in the market. It is basically a current market value, a latest value. It cannot be old, right? And many companies goodwill changes every minute, every second, every hour, just like stock markets, right? Just like stock exchanges, right? So if you understand this concept even a little bit, even if 20-30% you understand it, you will get the whole concept of consolidation. Okay, so again there are two costs that are involved. First is net assets, second is goodwill. Okay, so now this brings me to one more concept. It will just take 1 minute, it will just one small minute. Now what happens is that one word is called cost of investment. So in short term I can call that cost of investment is equal to net assets plus goodwill, right? Cost of investment is basically like what money we'll have to take from our pocket, from our bank, the final money that we'll pay. So the final money that we will pay to acquire the company will be equal to net assets plus goodwill, right? This formula is correct, right? So same thing is happening over here. You can see this working 3 over here as well. I'll just come back to this in a minute. First we have to discuss working 2, the net assets one, right? So working 2, this is working 2 and this is working 3. So working 2 and 3, when they're combined together, it becomes the cost of investment, the actual money that we'll take out from our pocket to acquire the subsidiary. Okay, right? Now let's come back to working 2 over here. Working 2, you can see this is just the first part of the cost, right? This is just the net assets. It is normally a very small amount. Now what we do is that we make 2 columns over here. This rulings, all of these rulings is given by the accounting standard. Nothing is by me over here. So it's same thing is written in the book as well, but I'm just making it simpler over here. Okay, now net assets, as you know, net assets, in other words, it is also called capital. We have discussed it before as well, right? So what happens is that we create 2 columns. First column is acquisition date, second column is reporting date. Okay, so acquisition date basically means when we acquired the company, at which date we purchased the company. It's written here as well, purchased, right? And reporting date is the year end, at which we report to the shareholders, the reporting date of the financial statements, right? So acquisition date and reporting date, both of these things we have to make alongside together. Okay, now what comes under this, what comes under net assets, we have already studied in this one as well. If I go back to the notes, when we are studying the normal, just a while ago, when we are studying the normal statements, right? So in the financial position, you can see only 4 things are there, right, in equity. And in this, because that this is net assets, also there are 4 things, the same things: share capital, share premium, retained earnings, revaluation reserve. Okay, right? So these 4 things are written, but this is of the subsidiary. We don't have to confuse it for the parent, because for the parent there is a separate detailed working. Okay, so share capital, all of these 4 things are written on acquisition date as well and on the reporting date as well. Okay, now the important thing over here is the difference between them. The difference between reporting date and acquisition date is known as which word? Post acquisition profit. It's very easy. Post acquisition profit means that after the acquisition. Post means after the period, right? So after acquisition till the reporting date, what profits we have got in between, right? Let's take an example. The reporting date was 30th December, or let's say in practical terms 31st December, right? So 30th December was the reporting date, the year end of the company, and 1st April, let's say Facebook acquired WhatsApp, right? Now, what are the months in between? What is the post acquisition period? Let's count: April, May, June, July, August, September, October, November, December. So there are 9 full months in this. Out of 12, just 9 months the subsidiary has been with us, not the other 3 months, right? Now everything that we'll do, this concept is related to this profit or loss, that this is called mid-year acquisition. Mid-year means that we have just acquired in between the year, we have not acquired it full 12 months, right? So these are just 9 months in between, right? So that means what we'll do is we'll just do everything for statement of profit or loss 9 by 12, right? We are just prorating it, just like we did in depreciation, like the useful life that we actually acquired, only that we are accounting for. Okay, this is actually known as post acquisition period, this one, right? And the difference between these two is called post acquisition profit, because these will be the profits that came in between this period, and these will belong fully to us, right? So this is the
difference between acquisition reporting date is called post acquisition profit.
Yes, exactly. Okay, right? Because mostly it will be an increase in value. Let's say at reporting because you see in between this line, in between this period, 9 months have passed, right? So in 9 months everything will have increased. Now always remember one thing I'm also explaining, this is just a top up over here. Share capital and share premium, these two amounts remain the same. This is, I don't think, written in the book. You'll have to understand it from the questions, but I'm telling you over here that share capital and share premium will be the same. Let me give you a logical reason for this. Everything has a logic, nothing is by me over here. Okay, now why is it same? Because it's a simple common sense. If I have purchased the company in 1st April, so now no one else can, right? If I purchased 100% of the company, now I will allow no one to purchase it because it's mine, right? So why would share capital of subsidiary increase in this case? Because no one else can now purchase the shares, it's mine now, right? So that's why it will always be same in this case between acquisition date and reporting date. This was the logical explanation for this. So only things that will change is retained earnings, this can change, right? And revaluation surplus can change as well, because obviously subsidiary will have some assets, right? Like car or a van or building or land, so it can increase in value at any time, right? And
when
retained
you say
earnings,
it changes,
yeah.
you know how you do, I mean, when you write down 9 over 12 months.
No, this thing is just related to the profit and loss, okay? Don't take it as a financial position item. This I was just explaining you for the explanation of post acquisition, the period between the acquisition and reporting. So only remember that retained earnings and revaluation surplus changes in this case, and the amounts you will not have to calculate it yourself. These will be given to you in the exam 100% in the question. Okay, right? Okay, so any questions still here? Anything which is confusing you? I may clear it over here. Is it are you clear about, are you following me till here?
Yeah, I think
okay.
Yeah,
Great. I'm sure when you'll revise this, it will be much clearer to you. And again, if you've understood this format, is if you understood this concept, it will be literally a piece of cake for you. Okay, now let's discuss these last 3 ones, the last 3 workings, right? We have discussed working 1 and working 2. Working 1 was just a mere formality, you can say. It's just like a diagram. If you don't make it, no problem, it doesn't matter, right? But working two, actual things start from working two. Working two was net asset of subsidiary, in which we make two columns, right? Acquisition and reporting date. Now let's see goodwill over here. Okay, so goodwill also has a formula. The reason there are workings over here is that they have each and every individual formula. Okay, now let me erase these lines that it's clear over here. Just a second. Okay, now let's see the format of goodwill, the formula of goodwill. So the formula is cost of investment. Again, this is same as this one. Like I just explained you cost of investment here, right? It's very similar to this one, right? So we do the cost of investment plus we do fair value of NCI. Now, why we are adding the fair value of NCI in the cost of investment? Because in most cases, we can say on paper that this happens, but in most cases what happens is that companies just purchase, they never purchase actually 100%, they just purchase like 70% or 80%. In this case, let's say they have purchased 70%, so there will still be some NCI, right? And that NCI will be 30% in this case, right? So that NCI will also have some kind of fair value. Fair value means market value. And shortly, in short terms, you can understand, in short words, right, short story, you can understand that the combination of these both makes up the full company. Okay, so 70 and 30 makes it 100%, right? Now imagine if there was 100% shareholding here. This all depends on the question. Imagine if it was 100% shareholding, then there would be no NCI, no NCI, and there will be no fair value of NCI. We'll just ignore this. Okay, so it all depends on the question what the requirement is over here. Okay, but the long story short, the concept over here is, the crux of this is that these both amounts make up the full company, because these both are the breakdown of the company. It is divided into NCI as well and the pocket money that we take out as well. Okay, right? Now we only minus one thing over here, which is net asset of subsidiary at acquisition date. Now after we minus this, we get the goodwill simply. Again, I'm explaining the same concept by the use of this formula. You can see this one. So same thing we're doing. We have to find goodwill right over here. So for finding goodwill, what we'll do is we'll do net assets, or basically cost of investment minus net assets, right? Same thing we're doing over here. Exactly same thing we're doing in working three. Goodwill is equal to cost of investment, the full company minus the net assets.
So the cost of investment is the net asset.
No. It is not the net assets. Net asset was different. Basically, cost of investment contains, you are halfway there, you're correct, but 50%. Cost of investment contains net assets as well and goodwill as well. When these both amounts are combined, that is the amount we take out from our pocket, right? Again, let me give you an example. I cannot just say, if I am Facebook, I cannot say that I will purchase WhatsApp in 15 million. I will have to pay the goodwill as well, the brand name it has generated after working 10-15 years, right? I will have to pay that in cash as well. And there will be expert valuers, those have measured this 6 billion. It's not just a joke amount, right?
So cost of investment is net asset plus goodwill.
Yes, exactly. Now if you understand this formula, you can easily calculate the goodwill as well. But I would suggest, just for understanding this working three, you can use this formula, but in actual the formula contains this one in the working three. Both mean the same thing, exactly the same thing, right? So it's like this. Let's say the total, let's take this to a smaller amount so that we can add it. Let's say this is 100 million. The goodwill was 100 million. Okay, so Facebook will have to pay how much? $115 million to purchase WhatsApp, right? Now let's say I was given with cost of investment, that is how much money I took out from my pocket, that was 115 million. And net assets I calculated using working two, that let's say I have $15 million. If I minus the net asset from the goodwill, which is 115 million, if I minus the cost of investment from the net assets, I'll easily get the goodwill. Goodwill is the extra amount that we have paid to acquire that company, and that extra amount is the brand name of that company, right, which it had made after tireless years of working. So we can easily say that the $100 million is the goodwill in this case, right? Now if you want to understand it with this formula, that is also right. If you want to understand it with this formula, that is also 100% perfect. Okay, right? The only thing that you need to keep in your mind is that cost of investment. Again, if any company is purchasing a subsidiary company, it needs to take out two amounts from its wallet. For example, it has a wallet in its pocket, right? It will take out its wallet and it will take out two amounts, not one amount. One amount will be the net assets. It will be a very small amount, right? And there will be a premium as well. That premium, that extra amount will be called goodwill, the extra brand name that the subsidiary has generated, right? So this is the concept over here. I hope you're following. I hope you're getting it.
Sorry, and fair value of oh my god, I don't remember how it.
Fair value of NCI, right?
Yeah.
This will be given to you in the question always, right? Now let me explain you this as well. So basically, if there is a company, let's say this is a company, this is a subsidiary company. Okay, subsidiary company will be made up of two things. One will be the parent and one will be the NCI, right? If the parent has acquired 100%, there will be no NCI because there is nothing left, right? There is nothing remaining. But in most cases, I told you in practical life, parents just acquire 80 or 90%. Let's say it has acquired 80% over here, 20% is the NCI. Now, actually, the market value of the NCI, if we go to the market for selling the NCI, what will be the market value? What will people ready to pay for it? This is basically called fair value of NCI. Basically, it's like a market value for NCI, the non-controlling interest. Okay, so this is the meaning.
So those work, that we are doing, the work free.
Yeah.
So I mean, that one is to basically acquire the whole company 100%.
Yeah. In every case, it is 100%. But it all depends. It all depends that if company is. It all depends that what parent wants. It can purchase only 50% as well, only 60% as well. It's not always 100%, right? And that concept I was explaining, that if it is not 100%, there will be some amount of NCI, which is fair value of NCI, that we will have to add. Again, I'm telling you again over here, what happens is these first two amounts basically make the full company. The same concept that I explained over here. Company is made up of two parts, right? One is the parent share, one is the NCI share, right? So same thing is over here. Cost of investment parent will pay, right? Not the NCI, because NCI is already existing over there. NCI is just the calculation of the remaining amount.
And the net asset of subsidiary company at acquisition date is not the same thing of the NCI.
No. For NCI, we don't calculate any net assets, because for NCI, it is just limited to the amount that is the fair value. Okay, right? And by the way, this net assets
is the market value.
Yeah, exactly. The NCI is the market value of the non-controlling interest. Okay, but don't worry, this is not anything which is tested in much detail. This will, like I just told you, fair value of NCI will be given to you in the question. I'm just explaining you the logic over here, like why this is made, why this is added over here, because these two amounts make up the full company, right? Okay, and basically this one is the working two, like I just explained. The working two, this one, you can see the acquisition date total of the working two is minus over here. We find it using the working two, net asset of subsidiary company at acquisition date. The reason we are not including the reporting date over here is that we acquire the company at acquisition date, right? Not reporting date. Reporting date is basically the year end in which we finish the calculations, right? So acquisition date is a more realistic figure over here, because these all workings we do when we purchase a company, not at the year end. Okay, right? Makes sense? Okay, now let's discuss working 4 as well. So fortunately, this non-controlling interest has its own working as well. We have to include this in the financial statements, in the statement of financial position. Okay, now this has a very simple working 4, fair value of NCI, right? We write this and we just add one amount, which is called NCI share of post-acquisition profit. Now this brings me to one explanation over here. We just saw this word over here, right? Post-acquisition profit. Again, the thing is, that if, let's say, there is 80% parent that has purchased the company and 20% there is NCI, right? Now, obviously, NCI persons will also get some amount of profit because they are equally responsible over here as well, right? So what happens is that this post acquisition profit is divided between parent and NCI, because you can see NCI is still part of the company. We cannot ignore that, right? Yes, it is very small amount, but no matter what the percentage is, it is still part of the company, right? So these post acquisition profits are divided between parent and NCI. So the NCI share we are just adding in this case. Let's say the post acquisition profits were $6 million, right? And the NCI in this case is 20%, right? So 6 million multiplied by 20%. This is the share of NCI. We simply multiply it with the ownership of NCI. Simple, right? And we get the final answer, which is non-controlling interest. Okay, got it, right?
Yes,
Yeah, sure. You can see if you have any issues, no problem. Take 2-3 minutes, because I agree the information is too much and it's very hard to digest. But you can just take some time. You can just see if you have any problem. You can let me know.
Sorry, the total is the non-controlling interest.
Yeah. Working for is a non-controlling interest. Okay, so how do we get non-controlling interest? We just add two amounts: fair value of NCI plus its post-acquisition share profit. Okay.
Well, we calculated that one already with, the fair value is not the same thing.
It is the same thing, but actually the non-controlling interest is not just limited to fair value. We have to add some amount in that, because you need you see, if the NCI is with the parent company for whole of the year, let's say, because it's moving alongside, right? It's not being kicked out of the company. It's moving alongside. We cannot. It will be unethical to kick it out, right? So NCI will also have some share of what the parent is having. All the benefits that parent is having, the NCI will also be having small portion of that according to its shareholding in this case. Okay, so for working for, we do fair value of NCI plus its share of post acquisition profit, right? Okay. Right, I'll send you these notes as well. You can surely revise them, and you know the first time, no student first time understands this topic. I've taught let me count how much student, like 13, I think you're the 14th one time teaching, right? But the good thing is that no students understand this first time, because it's a much difficult concept. They're studying it for the first time, right? So for the first time it is completely normal. You don't need to panic. You don't need to worry at all, because even if when I was at F3 level, I found I literally started crying after reading this when my teacher taught this, right? It was that difficult. But the thing is that slowly and gradually I got the hold of it, and I got, I practiced much questions, which we'll do hopefully in the next class. So practice is the key to everything. When we'll start to apply this knowledge, it will automatically be clear in your mind. Okay, right? Now let's discuss the last one, right? The working five, and after that we'll end the class and we'll continue on Sunday. Now, group retained earnings, this is the final one. Now this working is purely related to the parent. There is no other one in this. It's only purely related to the parent. Okay, now what happens is, even you can see in this, there is a evidence as well that everything included over here is of parent. Nothing is of subsidiary or associate or anyone else, right? Now you can see parents retained earnings. First we add this one, we take it from the financial position. In the question you will be given individual financial position, the individual statements of subsidiary as well, of parent as well. Now it's the accountant's job to add them together. For adding them together, we'll all doing this whole workings. This is the process of that. This is included in that. So parents retained earnings, we add this, and we add parents share of post acquisition profit. Now you see there is one simple method. This was a working related to non-controlling interest. There was no other one over here, right? This was purely for which one? Non-controlling interest. Similarly, working five is purely for which person? For parent. right? So you can see that in this case, NCI is adding its own benefits that it's getting according to the shareholding. Similarly, parent as well, in the second one, it is adding its own post acquisition profit. So the same thing I explained over here, that post acquisition profits are divided in parent and NCI both. So for parent, it goes into working 5. For NCI, it goes into working 4 in this case, right? Okay,
And
so the
that
last one, yeah.
That I mean, that total that you got from the work 2,
Yeah.
from working 2, that one is going to be like split in parents and NCI, or
Yes, exactly. Not basically not the total, just the difference between the totals. Because the difference I explained you, it's acquisition date and reporting date. So the difference of them is the post acquisition one, like what happened after we acquired the company, after acquisition, post acquisition. Okay, so the difference is
that
only divided.
will be split
Yes,
between.
exactly. It will be split. It will be divided between parent and NCI, because both are basically liable for that. Both are owners of that, right?
Okay.
Okay, so the last, there is nothing last over here. The final answer that we get is group retained earnings. We just add these two amounts. Now, what happens is that as we move forward in consolidation, I'll keep on adding some small and minor things in this as well. This is just a basic discussion, right? So these workings will be added with some small and minor things, right? So whenever, if you're making notes, if you're doing anything, just leave small spaces in between every working, because we will be adding 3 or 4 things in each of the working as we move forward. Because as I told you, this will take, let's say, 3 or 4 days to complete, because this is a mega topic.
This chapter.
Yeah, exactly. So I am basically taking it as one whole thing, one mega thing, which is consolidation. It contains profit or loss as well and financial position as well. So right now we have discussed, I would say, 95% of financial position. Just the remaining 5% is the financial statement format, the financial position format, that I'll discuss in most probably Sunday's class. Okay, got it. So I would suggest you should revise it. Just take rest, just take it simple, just take it easy, just revise this. If you again understand this one, this concept, that cost of investment includes which two things, what two things we'll take out from our wallet, right? And if you understand this concept, you'll easily get this concept fully. Okay, right?
Okay. Sorry, you're talking about the 21 and 22 chapters.
Let me check over here. Is it 21, 22? Yes, exactly. 21 and 22. So we have done 95% of 21, right? The remaining 5% plus the questions we'll do on Sunday, right? And the 22 chapter will probably start on the Monday's class, the profit or loss. So Sunday's class will mostly be spent on the questions of financial position. Again, the more the practice we do, the more will be good, and the remaining financial position as well.
And then which ones are left?
Yeah, let me tell you which one are left. Chapter 18, this is a very small one. This will be just done in, like, let's say half an hour or 40 minutes, right? That's why I'm keeping it at the end, so that easier things are at the end. The difficult ones are done at the weekend. Okay. And chapter 19 as well, this also involves some kind of discussion and one format, which is of cash flows, right? And this 20, this is basically ratios one. Okay, and ratios are very easy to understand. There are like 3 or 4 groups of ratios. So just small things are left. I would say medium based things, not very much long, not very much short. Okay, and all of these 3-4 chapters are very interesting ones. Unlike that accrual and
17.1, we already done that.
Yeah, the only statement of changes in equity is left in this. Statement of change in equity. Okay, right, got it.
And do you think that we'll have time to, to finish this, by Sunday?
Yeah, absolutely. By next Sunday, not by this one, by the next Sunday, because we will be having 4 classes, right? Monday, Friday, Saturday, and Sunday. So this can be easily managed in the 4 classes, and still we will be, finished before the lecture plan in that case. Okay, and normally I was saying to you that we will finish, the margin was 14th to 15th, right? So till 14th to 15th maximum, I'm